Hello everybody, my name is True Demon and I am the Devil Stockbroker. In this video, we're going to unpack what is currently going on with TRKA Media Group, ticker symbol TRKA. Moving straight into the charts, I know that everybody is freaking out and panicking right now because Troika moved all the way up to 99 cents and has dropped to a low of about 34 cents today. The after hours action that occurred yesterday was particularly scary for a lot of people because we returned back to a low point of 26 cents, which is actually just above my original entry back when this was called out by Hell's Trading Floor when we entered at 23 cents. So, obviously, there's a lot of people that entered in at a much higher price range that have been expressing some understandable concerns. So, I'm going to unpack what is going on currently with the stock and try to shed some light on what's going with the filings as well as go over the short interest details. So let's start with the technical analysis and get the easy stuff out of the way. So Troika has still got this initial floor set up at approximately 23, 24 cents. And it would seem to me that Troika attempted to hold this much larger support here at 35 cents. So we've got a lot of traded volume here in this range between 35 and 50 cents. I would say that a big portion of the volume, almost, I'd probably say about 20% of the volume that we have traded in the last 2 weeks or so is centered around this price range. So there's a lot of support here that Troika is working through in order to determine if we are going to move down further or if we're going to hold up the price here. So the after hours action was indeed really excruciating. It really was. So I don't want to diminish anybody's experience by just walking over that and saying it's like nothing, because I know that psychologically this was a terrifying move, and it messes with people. It's designed to. This kind of punishment in the market is designed to scare you, because remember that retail, or if you're new to the channel, maybe this is new information for you, but retail provides more than 80% of the liquidity to the market, and basically our 401ks, our Roth IRAs, and all of our investment portfolios, including retail investors that trade on their own, provide a massive portion of the liquidity that exists in the market. So most of the money that's being played with doesn't even belong to the hedge funds per se. It's provided by individual investors. I should say pension funds, but you get my point. So let's go ahead and take a look at where our big resistance currently is. So resistance is actually sitting right up at 50 cents. We hit it again today. So this was a first retest of this resistance. Now, what I suspect is happening is we are beginning to form an initial bear flag, basically. So a bear flag is marked by a sharp move to the downsides. This is what we call the flagpole. And then there are resistances moving in an upward trajectory to the upside and supports on the downside. We've already touched these supports down here 3 times. Typically on the third or fourth test of a bear flag, the price continues to move down. So what you expect to see from a bear flag is a failed retest of this 50-cent level and then a rejection to cause a breakout on the last retest of support and then a move to the downside. So this is what bears are expecting. This technical setup is basically an impulse move to the downside that pushes the price down sharply, and then it attempts to make a rapid recovery but fails to break out of resistance and gets pushed down by the market again. So that's currently the move that that everybody is currently afraid of happening now, at least as far as a technical perspective is concerned. Now, as far as the situation with the company goes, we should probably go over the short interest because that's an important factor to consider when we look at the rest of these charts. So moving on to the Ortex data, we can see that the estimated short interest percentage of the free float is still at 68%. That's a very large portion. And remember that I did mention early on in my videos, and I may not have said it in every single one of them, but a lot of the Ortex data is not real time. A lot of this data is dependent on the 2-day settlement period, which is T+2 settlement time. Maybe once the SEC pushes through T+1 settlement, we'll be able to get this data more timely. But for right now, this data you should look at it through the lens of this is 2 days delayed. It's 2 days old. So with that in mind, when we look at this ridiculous price action and we see the days to cover moving sharply down, we see the short interest moving sharply down, and we see the price moving sharply to the upside, it does indicate, at least on some level, that shorts had been covering and been a part of this move. So shorts being guaranteed buyers when they try to close their positions have definitely been a part of this move. There's no way that shorts haven't been involved in covering to some extent. You can actually also corroborate this with the average days on loan. Back on the closing day of Thursday, March the 2nd, average days on loan was 9 days. So notice that this moved up really sharply, along with a big move to the downside in the percentage of the SI percentage of free float moving to the downside. When these two things are moving opposite each other, it usually indicates a covering event. Specifically, when you see short interest moving down and average days on loan moving up, that means that recent shorts are closing their positions. Shorts that have been in their position for a long period of time, we're thinking anybody who's been in their position since before 25 cents, they are still most likely in their position. Because if you notice, going back here, there was a very long period of time where a lot of old shorts had positions and then they covered all at once. You can see there was this big spike candle, this big hammer candle that happened on January the 17th. And then the day after, average days on loan basically collapsed and there was a little bit of price action to the upside afterwards. That's an indication that old shorts covered their positions. Now, there wasn't very much short interest at that time. It's been climbing ever since then. And notice that as the short interest climbed, the days on loan got bigger and bigger and bigger, slowly, gradually over time. This indicates that shorts were slowly entering positions. By the time that we had reached a price of maximum, the maximum price that shorts had gotten into their positions at was 30 cents. At the low end it could be 25 cents, on the high end it could be 33 cents. But the best price that the majority of the old shorts could have got into their positions was at their best price, 33 cents. From that point forward, a bunch of new shorts have been getting into their positions. A lot of these guys got slaughtered. Notice that the days on loan from this point started moving down in its average as the short interest was climbing. This means new shorts entering positions. And then finally, within the last 4 trading days, short interest collapsed and average days on loan shot up very quickly. So that confirms for us that recent shorts cover their positions. So they've only been in this play for about 5 days, and a lot of these guys were getting slaughtered as the price was moving up really, really, really fast. That tells us a couple of things about the psychology of this play right now. One, shorts really thought that they were going to be able to punish this stock price very quickly and get a big, quick profit out of it. And they ended up being very wrong, so they got punished for that move. And then all the old shorts, they've been maintaining their positions. So either they're trapped, they have plenty of money to sustain the move and are confident, or they have plenty of money and they know something. So those are the 3 possible scenarios that we have in front of us. But either way, the old shorts, since 30 cents and below, for the most part, are still in their positions. The shorts that recently got in and got smacked when the price shot up to almost $1, they got slaughtered and they're getting out fast. They ran for the door and all the fire exits were blocked up until that recent 10KT filing, which was the financial update filing for Troika. So we're going to go and take a look at some of this. I'll go back up to the top of the filing and we're going to go and investigate what exactly was going on. So this Form 10KT is a augmented financial status form that just basically is the company issuing status with the SEC for where their current float is or their outstanding shares, more specific. Factors are for investors moving forward. This is a required filing, especially since they've been pretty late, as I understand it. So this was a bit overdue, but all the same, they have issued this filing. So now, as far as the SEC is concerned, near as I can tell, they are in good standing with their filings status. So so briefly, let's look at their business transformation section, because this is the good stuff. This is the good part of this. And it showed that there was a very large amount of revenue growth for the company. So Troika did very well in terms of its growth of revenue. They added some new clients, most of which are very, very large clients, and they are not contracted clients, so they're not in any formal contracted agreement with their clients. So it's an at will agreement that they will be working with Troika. That basically means that they can fire Troika anytime they want. So that's actually not a very positive thing, just because it creates uncertainty if any one of their big clients decides, hey, we're gonna go with a different marketer, then it would hurt Troika pretty badly. So that's one of the risks. That's an example of a risk factor in the company that they're going to talk about later on in this filing. So this is more of their like business philosophy stuff, talking about the Converge acquisition for a price of $125 million. It was, it's all good stuff as far as like, increasing their business capability, but not really the critical part of what's been happening with the company. Their biggest struggle right now is that they have a bad financing agreement that was necessary to keep them going, and Blue Torch has basically put them up against the wall. They're not, I would say that Blue Torch is being difficult, but they aren't unwilling to work with Troika. So it at least tells me that they're not trying to strangle the company to death. But at the same time, Blue Torch is kind of playing hardball about, making these on time payments and everything, because they want their money too, which is justifiable. But it's putting Troika into this really difficult position with its shareholders and its ability to generate more revenue and get to a positive earnings. So here's the part where things get a little bit scary, and I think that this had quite a lot to do with the big sell off that occurred. So the big thing is that the big part of this is going to be the preferred E series shares of stock and the warrants. So this is what everybody's been talking about when it comes to like feared dilution of the stock. And I'll cover that in a minute, but we're going to go through some of these other risk factors. So the first one that they mention is the Converge acquisition is expensive and costly and is going to take time. That's an easy one for them to get out of the way at first and kind of tire out the reader in hopes that they won't dig very much further, because this is actually a positive event, so it makes it seem like less risky. The second one is that they are relying on a rapidly changing industry, which is true. Marketing right now is not really a good field, just because the market overall, like, talking about consumer market, has been struggling because of inflation problems, supply chain problems, and rate hikes from the Fed. These guys are affected by all that stuff too. So this is one of the risk factors that is important. This is what I just talked about. The customer concentration risks. They have 6 customers that accounted for 85%, 74%, and 42% respectively of net revenues. So they are being upfront and honest about this, that if any of these customers were to bail out on them, it would seriously impact their revenue. One of the biggest benefits for Troika, them being a big marketer, is that they have been able to land some really huge contracts with some big companies, and they've done really well with their marketing material and created some really successful, impressive visual campaigns. They've done a really great job with it, and it attracted some big customers that decided to give them a shot and were blown away with their expectations. It's fantastic, but it is a risk that their customer base is very centralized on these very large companies, and that's a risk for any small business. If they fail to meet their customers' expectations, they could leave at any time, and there's no contract protecting them from that decision. So if that were to happen, Troika would be left in a really awkward position where their revenues could be affected. And that is the very next risk that's mentioned is that there's no long-term agreement. Their clients do not work exclusively with Troika. There's no exclusivity contracts or anything like that, so they can work with their own competitors and other things like that. So there's a bunch of uncertainty with their customer basis and the market and stuff that is really beyond their control except for their ability to continue producing excellent marketing product. The next thing that is concerning is that there's litigation that may distract management, and this is kind of a very realistic fear because of what's going on with the preferred E Series stock and Blue Torch, their financier. The financing company could at any time decide to pursue them for damages, as well as the preferred E Series stockholders. They could try to pursue Troika for damages because of something else. So there was a big investment that was made by some stockholders that bought those preferred E Series stock that I talked about. Troika made a mistake when they issued a certain filing. So, because of this mistake that they made, it is possible for the preferred E Series stockholders to seek damages if they decided to pursue that avenue. I don't think that it would benefit them in the long run because it behooves them more for the company to succeed and survive because those preferred E series shares of stock kind of act like warrants in a way. Those shares of stock can be converted into common stock, which is that's the stock with the real voting power for Troika. So it benefits those preferred E Series stockholders to hold on to their shares and convert them in order to guide the company and continue holding them up. It doesn't actually benefit the preferred E Series stockholders to convert their shares. It would be quite costly for them to do it. And by the time they got done selling all of those positions, it would really probably not work out in a net gain for them. They would probably end up taking losses for it. But nevertheless, it's a risk. And the fact that they can pursue damages and litigation against Troika if they perceive that they've been cheated and they decide to go that route, then not only would they be selling their shares of stock, they would also be trying to come after Troika for more money because of screwing up in their own obligations, and it's kind of a mess. So because of that, there's some serious concerns. So this was the part that had to do with Blue Torch and the Converge escrow account. So there was a perceived conflict of interest between the CEO and Blue Torch and Troika, and because of that, that's opened up some potential litigation. So you can read this. You can read this on your own. But as it happens, it would seem that funds were withdrawn from an escrow account that was maintained by Blue Torch ahead of uh, ahead of what was agreed, and Blue Torch did not consent to the release of the escrowed funds, which was required by the escrow agreement. So, because of that, Converge, the company that Troika purchased, has the ability to sue them for the unpaid portion of the purchase price and or for failure to obtain release of the escrow of the Converge holdback funds. So because of that, that it does create a conflict of interest because the CEO is one of the Converge sellers. So he is entitled to approximately $4.7 million of the Converge holdback funds upon its release from escrow. So therefore, the interests of the CEO in negotiating with Blue Torch may be different with the interests from the company and its stockholders. It does not mean that the CEO is opposed to the success of Troika, but it simply is pointing out because it is required legally for them to do this. They have to annotate and publicly release information that is pertinent to the success or the outcome of the company's performance and any conflicts of interest that arise between members of the board or the executive staff. In a matter of good faith decision making, the CEO has agreed to recuse himself. That means step away and not make decisions from any decisions relating to the release of the Converge holdback from escrow. The risk remains that such conflict of interest could result in agreements with Blue Torch that are less favorable than those who would have obtained in the absence of such conflict of interest. So, just in order to express a show of good faith, the CEO isn't making any decisions when it comes to the withdrawal of those funds, so that Troika can continue to have access to them, and he's not going to step in and influence any decisions in order to kind of alleviate that conflict of interest, because that exposes him to legal pressures too. So it wouldn't be good for him to engage in any activity that could be perceived as a conflict of interest. And then there is the event of default that we have to look at. So now you're kind of starting to see why there was so much concern after this filing was released and why the shares just started to plummet. So I do think that shorts kind of knew that this was coming to some extent, because there was a long history for people that had been researching this company long before I even started becoming aware of it. Those guys had the benefit of much deeper research and possibly like going as far back as a year of additional context and maybe even insider information that none of us in the retail public are privy to. But as it happens, Troika screwed up, and they had to enter into a limited waiver of certain offensive events of default under its credit agreement with Blue Torch. So Blue Torch, the company that financed Troika and handled the Converge escrow situation, entered into an amended and restated limited waiver of certain events of default, such as the events of default from the specified events of default, basically saying that they failed to make payments on their loans, and they they went into default with their lenders. So that puts the company at risk for litigation and pursuance of damages. Like at any point, Blue Torch and the lenders that it represents could come after Troika for their money back and start like trying to force liquidation and stuff. And at that point, then Troika would have to engage the bankruptcy courts and seek Chapter 11 bankruptcy or Chapter 13 bankruptcy in order to protect itself and figure out a restructuring agreement. So that is a real concern that needs to be acknowledged. We can't pretend that it doesn't exist. So for right now, this limited waiver gives Troika some leeway to make payments and make up for the default with Blue Torch and the lenders, and it's subject to a potential of extension of up to 60 days to obtain regulatory or shareholder approval in the event the company is pursuing a sale transaction. So the consequence of them failing to remediate the default is that Blue Torch could start charging them additional interest, penalties, and other fees that would really hurt the company and make it even harder for them to pay back the debt. This is what they refer to as accelerating the indebtedness under the financial agreement, and seek to exercise other remedies, such as litigation. So, coming after them in court. So right now, Blue Torch is playing ball. They're giving them some leniency and giving them more time to make up for the default and pay back their overdue payments without penalty. But they can change their mind at any time, and they don't have to agree to a 60-day extension if they choose not to. So how Troika handles this situation going forward is going to be really important. The next part has to do with the Series E stock. So when it comes to Troika, the thing that scared the absolute hell out of all of retail was they saw a bigger number on the outstanding shares than they were prepared for. The fact is that these shares were always there. If you look at dilution tracker, which I have gone over this in past videos, the dilution tracker shows that the company has had 344 million shares, give or take a few hundred thousand, and convertible preferred stock. Now, a few weeks ago, this was marked as these shares were marked as still unconverted because there had not been an update to the conversion. So, as far as anyone was aware, those preferred E Series stock had not been redeemed and converted into common stock. Now, it is our understanding that they have. These shares were already out there. They were not being traded, they were not being sold and bought, they were being held by other holdings companies that were entitled to convert them once the share price exceeded a certain level, and they were able to pay the conversion rate of 25 cents. We'll get back to the filing so that we can read through that. But the company had 310,793 shares of Series E convertible preferred stock outstanding with an aggregate liquidation preference of approximately $31.1 million. And the conversion price to common stock was set at 25 cents per share. And this is therefore convertible into an additional 124,317,000 shares of common stock. There's a conversion rate and a conversion ratio of preferred stock to common stock. So once these shares are converted, it is possible for them to be issued and sold into the market. And this would, in effect, create a dilutive event. So far, as we understand it, this sale has not happened, the conversion hasn't completed, and the shares of stock have not been sold into the market. Now, an additional complication of this is because of a problem with their SEC filings, Troika made a big boo boo and created a situation where purchasers are entitled to partial liquidation damages, of which $3.6 million remains unpaid. So those companies could try to sue for that additional money, but it sounds like Troika is working on paying them back. But the reason why it came up was because Troika screwed up and they messed up their SEC filings, and that prevented that company from being redeemed and made whole on their agreements for those preferred Series E stocks. The company filed a registration statement. This is an S1, the shelf offering. But because it was not declared effective, it was withdrawn. And that's why we see that those outstanding or those authorized shares were never approved. And therefore, that S1 filing was pulled back. And that's why when I began this play, I saw that and said, okay, so they're not able to dilute now. The company itself is not able to dilute, but the companies that hold on to those certificates of preferred Series E stock, they can. They can redeem those. They can convert them if they're willing to pay the money for it and sell it into the market. The problem is that I think that it would be more costly for them to do it than they would actually receive any benefits from. So it's not actually in their best interest to do that. I don't think that they would be able to sell out of those positions before they drove the company down into the sub penny price range and basically make it impossible for them to redeem any cash, and they would be worthless. So they would be shooting themselves in the foot if they started selling those at insane prices. The other possibility, though, is that the company knew this all along, so they decided to short Troika into the retail pump and cause the price to collapse once they started selling. So we don't actually know. It's very difficult to track these transactions in real time. None of them are transparent. There's no way to actually know. And, to some extent, I don't even think that Troika, the company itself, could possibly know. These entities are entitled to make these decisions entirely autonomously. The only thing that Troika is privy to is when they decide to convert and then pay that conversion fee. So Troika has nothing to do with the sale of this stock. These shares existed more than a year ago. So this has always been on the table. But right now, we don't know if those shares are being sold. We also know that there are warrants that have been redeemed, but we don't know if any of those shares have been sold either. So there's also no way to know that. And if you're confused about what a warrant is basically, you can think of it kind of like a call option. It's the right to purchase shares of common stock on a one for one basis. So one warrant equals one share. So if you buy a warrant at like a really, really cheap discounted price, you can redeem it at a conversion price similar to the preferred E series stock. But the point of the warrant is you buy it when the company needs funding, and then what happens is when you redeem that warrant for a share of stock, the company pays you that share out of its own pocket. It it in effect does dilute the float because it adds it into the tradable market. As soon as you redeem a warrant, that warrant becomes a share. That share is can then be traded in the market. So the final piece that is a concern that we need to go over is that the company is out of NASDAQ listing compliance. There's an added complication to this too. So we all know what it means when you fail NASDAQ listing requirements. It means that the company can be delisted from the exchange and it gets moved to they call it the penny market or the pink list or pink stocks. It's the penny stock market or the OTC market, over the counter. So in May, specifically May 20 May 20th, 2023 is going to be when they no longer or I'm sorry, May 15th. If they do not regain compliance by May 15th, then they will be unable to regain compliance unless they make an appeal. They can make an appeal by issuing a plan with NASDAQ in order to get compliance by lifting their share price to above the listing requirement of $1 per share. The problem is that the standard way of doing this is a reverse stock split, and Troika is in a unique situation where there is an agreement in the preferred E Series stock issuance that they are not permitted to engage in a reverse split. So because of this, their one option that the company has full control of doesn't exist. They cannot reverse split Troika stock in order to maintain listing requirements. So that means that the company's price has to go above $1 10 consecutive days before May the 15th, or the company will be delisted. So all of these are essentially what's going on with Troika. This is my full breakdown of all of the findings and the risk factors for the company. There's not enough information for anyone to really truly know for certain what's happening. So I'm doing my best to unpack this information and clear up any misconceptions or miscommunications or misunderstandings about what these filings mean and what the outcome could be. Unfortunately, I know that this video isn't exactly the most bullish sounding thing in the world, but as I look at the share price bouncing off of 40 cents and just kind of watching Troika dance around in these price ranges, I do feel at least a little bit encouraged because Troika is holding up this level of support that honestly it never should have been able to hold up if there was just going to be a mass sellout into the market. It also indicates to me that most of the shorts that got into their positions originally, they're only just barely in the green, and probably some of them are still actually having quite a bit, are still experiencing quite a bit of pain. Most of the trading where the shorts entered their positions was here, and there was a little bit here. So there's quite a few guys that are still in the red right now. Any of these shorts that timed things perfectly and were able to exit in after hours, which there was a lot of that happening in after hours on Tuesday. I doubt that all of them were able to escape all at once. It would have been extremely difficult. And looking at the Ortex data, we can see that, in fact, there's still quite a few that are left behind, at least for right now. The last thing I'll leave you guys with is the short exempt stats from the market. Currently, we don't have the latest numbers, so this last row is basically empty. The zeros don't mean anything, just the data hasn't been updated yet. It's going to come out in a couple of hours. But yesterday, we had more than 10 million short exempts come through on the market. And I suspect that this explains a lot of the massive price action to the downside, pushing the market down. We had 153 million shares of short volume driving the market down, and about 550 additional shares of traded volume happening in the market at that time. Now, the short volume can be both shares or shorts adding to their positions or covering their positions. The volume here suggests to me that there was a lot of legitimate selling happening in the market that was driving it down. And that does mean that some of those guys that may have converted their stock ended up selling into the market and driving the price down. It's a lot of volume. It's a lot of volume. And since there was confirmation that some of those E Series stock were converted, that there is distinct possibility that some of them may have sold their positions. So right now, we can only really just watch Trika to see how it responds to these levels and see if it does, in fact, get a little bit of more strength and bounce from here. But I want to be perfectly honest with everybody that right now, the biggest reason why this is becoming so painful is because now retail is panicking. And that's not to blame people. It's just a fact that retail panics when something like this happens. When the stock gets driven down this much, the buy and hold mentality falls apart because everybody starts getting scared and worrying about their own individual situation. And I'm not going to fault anybody for doing that. It's actually really important to manage your risk. I was even talking about it, the video preceding the day that this sell off occurred. And before anybody even accuses me for it, I had so few shares that like it literally wouldn't have even been a blip in the market. So like before anybody accuses me of being some crazy whale that sold at the top, like I had I had a 4-digit amount of shares. Okay, it's a very small position. Okay, I'm not going to disclose my full position, but I can tell you that it was 4 digits, so it was very small compared to the float. Okay, so there's no way that I move the market before anyone tries to accuse me of that. The situation that happened yesterday was entirely because of institutions. Now, it could be fraudulent, it could be legitimate. We don't know. But the uncertainty and the panic that retail is experiencing right now is part of the reason why this has become so difficult and why it's going to be really, really hard for Troika to squeeze at this point. I don't think that it's impossible, especially with the short interest still being so high. We've seen stocks like Redbox have this happen, where it shot to the moon and then instantly got vaporized in a single day, like in less than an hour, totally vaporized, and yet still was able to rebound later on. And Redbox was able to exceed its previous highs after that happened. But all of that requires some level of conviction on the whole of retail holding together and going and pushing the stock price forward anyway, which is a really risky thing to do. It's a really risky endeavor, and you have to have a lot of guts to do it. And it's not something that I think that people should do with the mindset that they're going to get rich doing it. It's hard. It's really hard. And 9 times out of 10, it's not going to be successful. But there are times when it is. GameStop was one of them. Redbox was one of them. AMC was one of them. Those and SPRT. All of those situations were examples of where big squeezes and big sell-offs came back out of nowhere and sent the prices of those respective stocks shooting to the moon in spite of all odds and despite all of the FUD and the uncertainty that was circulating in the market. It can happen, but I don't want to set people up for failure. So I'm trying to be as neutral, objective, and unbiased in my analysis here, and I hope that people can understand that. So for that reason, I am suggesting that nobody enter into new positions without the full understanding that this could get your money can get deleted instantly. Okay. I've re entered into a position because I am willing to lose it. I am willing to lose it all. It is not a massive position. Honestly, my individual position is so small, it probably doesn't even matter in the grand scheme of things. But on the off chance that this does squeeze, I want to be a part of it. And if there are people that are holding with me, then thanks for being here, and I wish you and everybody else the absolute best of luck. To everybody else, congratulations. I hope that you were able to make this a win for yourself, and good on you for managing your risk. And I hope that at the end of the day, we've all won and learned a lot more than we've lost. That's going to be it for me on this video. I look forward to seeing you guys in the next one. Until then, have a hell of a time in the markets.